So I want to talk about the intermediate famous investor model. And since I've gone through what's included with the newsletter, I thought, if you want to rebuild the models on your own, I'll just go through a little bit of that here. I'm not going to cover it real in depth. I'll leave that for the course. But basically, if you want to rebuild the models on your own, you'll need to get a subscription to portfolio123.com. And inside of there, you'll be able to go through and create a stock screen. As far as the pricing goes, uh, you can use their screener for $25 a month. And if you want to get all of the tools with the more advanced features, then it's 125 a month. And I don't have any affiliation with them. That's just what it is. But um, so you want to come over here and you want to say, I want to make a new stock screen. Now, before you let your head, get out of whack with all this stuff that's here, don't worry about any of this. But if you want to start, learning about what's in these books that are written by famous investors such as Warren Buffett, Benjamin Graham, Joel Greenblatt, Bill O'Neill's CanSlim, all of the stock selection criteria based on the company's information. And again, if you're not a finance person, don't leave. There's plenty of information here for you. Let's start with the group that's not finance people. Just know that you know there's a lot of stuff behind the scenes, and it all lives right here. But you want to come and start a new screen, you need to tell it what it is that you want it to do. So how do we best relay this information? Well, um, I think I gave my paper out at some point for those that subscribe to the free um, trial of the famous investors. But if you don't have the paper, you can get it from my scholar, and I can link it in the members area. And if you want to look at each model, you can see the rules and the steps. So Warren Buffett, it is looking at, you know, again, if you're not a finance person, then what you want to do is basically just come here and copy, paste, add freeform rule, copy, paste. That's how you rebuild it. If you want to look at, what was built in the paper, you're rebuilding this blue line right here. So, come down to this part of the paper, copy, and paste. You're not a finance person, but you want to rebuild the portfolios. That's how you do it. You want to learn more about this stuff? I can break it down for you. You don't want to learn more about it? Copy and paste it. I mean, honestly, you can almost just get by with just copying and pasting. And then what I can do is teach you, how to look at what rules are contributing to the model and what ones aren't. And the ones that are, you want to leave in it, and the ones that aren't, you want to take out of it. So let's just rebuild the Buffett model this way for now. So we can run the screen. There's an error. What's the error? It's a typo. There's a space between the hashtags. So let's run it now. So these are all the stocks that passed. There's 20 stocks. Let's back test it. Add every stock every month. It's not put in any values here. and let's take it at the next open, and let's take it on all U.S. stocks. Drinking some Red Bull. I was in Las Vegas last week, and I got dehydrated, and I lost my keys and a pair of headphones, but I don't drink, so that's about as wonky as I got. And I usually don't ever misplace things. I think they just fell out of my pocket when I was in my room, and I don't know what I was doing, walking around too much and trying to push my limits of how little food I could keep in my body and how long I could stay up, just to like fast and know what my bodily limits were. And I found them. So probably won't do that again. But I sat out in the sun a little bit too long, and usually I'm too tapped in to lose things. But occasionally the headphones fall out of my pocket, and they're tough to find. I've been lucky to go back and find them, but fortunately I bought another pair. So I don't talk much about personal finance, but I think the rule of thumb is like buy stuff for other people, not yourself. And if you're gonna buy stuff for yourself, buy stuff you can afford to buy two of. So yeah, it didn't set me back too much. I got my keys replaced. Anyway, so let's look here. So here we go. Here's the Buffett model from the paper. That's how you rebuild it. And it does the same thing as the paper. So now the screens that I send out, they're modified. I went through and I did what's called a stress test. I basically took all the rules. Again, you're not a finance person. We don't need to talk about what they are. But I just turned them off one at a time, and I reran it. And I looked at the return. Let's keep it even simpler. Does this number get bigger or smaller when you turn that rule off? We already talked about Sharpe ratio, so you should be familiar with this term. Let's keep it focused on the Sharpe ratio, because just because this number goes up, we want to make sure it goes up enough to compensate for the risk, which is measured here. So let's just keep it on the Sharpe ratio of 0.67. Let's turn the first rule off. Let's rerun it. That's not all that I do. I do a lot more than that. And I'll try to cover everything I do in this video for just this basic version. And then I'll talk about ranking, which is what I do for all of them. And then that'll be it for the overview. But in the course, I'll break everything out even more, because when I was making the model, I had developed a track record with CanSlim. And my dissertation advisor was the one, Tarun. He said, if you're going to look at CanSlim, compare it to Buffett, compare it to Greenblatt, compare it to other famous investors. And I let that simmer for a long time. I think we had that conversation back in 2015, and it wasn't until 2021 that I gave him a call. And I asked how he was doing. And we caught up, and he wanted to continue to work, and I wanted to continue to work, and I let him kind of guide me on what was needed to do. And it was, let's learn all the rules of the famous investors, starting with who are they. Looks like it's about the same, so let's leave it off and let's turn off the next one. So this is not stress testing, this is factor model building, and I got that idea from somebody else. So let's stay with Tarun. So Tarun said, who are the investors you want to compare to? Well, Warren Buffett, Benjamin Graham, Joel Greenblatt. Those are the main three. Magic Formula. Peter Lynch also, at the time, he was one of the ones that I had talked about. And there's two others that I had brought up lately, and introduced the idea to two of my students when I was at IU to work on, and they didn't want to work on it, but I may have a new co-author pick it up. We'll see. Anyway, Lynch got dropped for whatever reason, and we stuck with Buffett, Graham, and Greenblatt. And so then what we did was we went through and looked up the books, summarized what the criteria are for Graham, there's 3 different versions of his type of investing. For Greenblatt, it's very simple. It's a very simple formula based on rate of change, which is momentum, and then quality. And so here the returns went down, but the Sharpe ratio went up, and the maximum drawdown went down. So let's leave that one turned off, and let's turn this one back on. And so I got the paper out. We published it in 2023, and I got to go and present my dissertation, which was with my other advisor, Neil Maroney. Tarun and I were going to do a dissertation in corporate finance, and we never finished it up. So I think I gave the idea up to somebody else, and they finished it for their dissertation. And with Neil, we worked on a paper by Andy Lowe looking at technical stock price patterns. And my undergrad and MBA advisor is the one who gave me the idea. He didn't give me the idea. He knew that I was looking at technical analysis as term papers, and he knew that it was an uphill climb to do that type of work in academic finance, which if you're not a finance person, you wouldn't understand why maybe. But I guess it's not even something worth discussing if you're not a finance person. So I'm trying to keep it simple. But it was a challenge to introduce the ideas, and the paper by Lowe was so groundbreaking and in such a high caliber journal that it gave a framework or starting point. And at the time, Neil wanted to look at machine learning and image processing, and so I said, can we combine that with something like this? And that was after I already brought it to somebody else who said they didn't know how to even approach that topic. But Neil was like, yeah, I can do that. And so we just cracked right in, and he gave me stuff to do that I couldn't do, that was over my head and was way too hard. And I worked on it. But we finally got to go and present together in Houston at a conference called Southwestern Finance Association. And that was after this paper was published, and I was showing him the results on my laptop saying, here's this model, here's what it does, here's this model, here's what it does. And I was replicating the paper in front of him and making sure that all the rules with each model matched what the model said it should do. Red Bull and water, got to drink water to hydrate. So he said, why don't you do a factor model? And I was like, okay. I kind of knew what that was because I picked his brain a lot in econometrics too. And we talked about, looking at regressions with, you're not a finance person. It's not over your head. You just, think about something else while I talk about the high level stuff. Think about music or jazz or dancing or something. So we were looking at, running regressions and looking at factors of dummy variables, which is like, a 1 attached to whatever you want to measure and a 0 attached to whatever you want to measure. So I was working with a MBA who worked for a company similar to the one I interned at and worked for, who was familiar with some of that. And so I kind of already understood the concept, but basically now that we're inside a portfolio and we're not running regressions and we're keeping it so simple, it's just taking each rule and turning it on or off and seeing how it affects the returns is basically what it is. So, okay, we're looking at the Sharpe ratio. We've got a bigger number. Now let's go here. So that's just factor model. That's just one piece. And so we have to go through all these rules and look at the factor model that produces the highest Sharpe. However, we're not concerned with the highest Sharpe over the full sample. What we're concerned with is a consistently high Sharpe over multiple overlapping periods. So keeping the same end date, which is today, and then looking at like how it does a year ago, how it does 3 years ago, how it does 5 years ago, how it does 20 years ago. That's called stress testing. So we want the model to hold up over every time period. You can see this is very time consuming. So I've done this for every single portfolio. There's 12 portfolios. And this is just the screening rules. So that this is the second layer. And so I'll go through a few more. Maybe we can go through all of them on the factor model just so you understand what it is and how to be thorough. So if you want to go to the paper, copy and paste all the rules, and you want to go through this process with one of them or part of one of them, you can understand it better. You don't have to do it with every single one, but at least you'll have an idea of like what it is. Here we got just getting rid of this last one here. So these three rules were part of, don't, you're not a finance person, don't leave. There's different rules. It's like making a cake. Like you've got, like one layer, and then you've got another layer, and then you've got the stuff you put on top and all of that, and how you present it. How you present it, right now the cake's just in the kitchen, but it's like, what do you want? Do you want a chocolate cake? Do you want a shortcake? Do you want it with strawberries on top? Do you want it with chocolate chips on top? Do you want a cake? So think about like the Buffett models, like your strawberry shortcake, and the Canson models, your chocolate lava cake or layered cake. So think about removing each one of these rules is removing like one ingredient in the cake. So like, how does it taste? Does it taste better without this ingredient? Does it taste better without this ingredient? What about, oh my gosh, wow, this tastes so good. Now we got rid of all three. Well, how are those three ingredients related? Well, they're part of a group. Does that make sense? So I don't know much about baking, but like imagine like you got rid of like, I don't know, the flour, and you replaced it with like a different type of flour. And what's related to the flour? Like the egg. Like, okay, you didn't use the egg, you used like an egg substitute. And then you didn't use sugar, you used a sugar substitute. So like each one by itself has like a little bit of an effect, but getting rid of all three, that's where the magnitude is. So that's what I did. And so getting rid of these three, it really jumped the sharp up. Now, and by the way, you're not a finance person, now you're a little interested. What are they? It's earnings per share. So how much earnings does the company have at the end of the day? Let's look at return on equity. So what's the return the company makes? So you're not a finance person, I made you one. Yeah, you can learn this stuff. It's not, just pick it up right here. You don't need to go back and restudy finance. I'll teach it to you. It's not hard. You just need somebody that understands you where you're at, understands this stuff, and can take it and put it on your level. And I don't know you, but I understand where a lot of people are, and a lot of people that are very smart with various educational backgrounds that are capable of learning this stuff. So let's let this go. It takes a while. Like I said, I've spent lots of hours on this. I don't even know how many hours I've spent just thinking back to when I first learned this stuff with Rich, and he handed me the book and I read it, and it was simple. And before that, I read a book called The Little Blue Book on Investing, which was actually Joel Greenblatt's book on investing. And here's the thing: before your eyes bulge out, this is why I put in cutoffs. There are certain rules that will break it, and this is not realistic. And I'll take a few minutes to just explain to you why it's not realistic. Just imagine we're on the big wide road, we're going together, we're in a van, but now we got a little fork. We're still on the big wide road, but we have 181 million percent return. Why aren't we using that? So let's just take a nice little off and look at, and then get back on the road. That's all we're going to do. So the Sharpe ratio dropped right way down, by the way. So from there, we could say, I don't want to use it, but like my eyes are bulging. Like I want that return. I don't even care what the risk is. We haven't talked about like risk neutral versus risk. You're not finance, don't go away. Don't worry about risk neutral. Don't worry about it. I will take as much risk as possible if I think there's a return. All right. So we know how this works. Let's go down to where we earn that really big return on 6/16/24. And then let's look at what stock earned that return. I don't even see it. I see one stock earned 50%. So how did the whole portfolio earn 1,000%? Do you see it? I don't see it. Oh, there's 1,000 stocks in the portfolio. So let's just sort by percent. There you go. This stock started at zero, ended at a penny, and it produced 99999. Your eyes are as big as mine. Why don't we just buy that stock? Help. No, I don't want to leave the site. I want. So if you click on that, it'll bring you to their website and show you what they do, which is actually really cool. I want to look at the chart. Look at this stock. It goes from zero up and down and up. And so this happened back in June of 24. So it found the stock back in here and it bought it and it sold it. It seems really reasonable and it makes sense to me. And I'm glad the rules are working. But I'm going to bring us back on the main road here. Um, if you go in and you try to find this stock, you won't see it quoted at these prices. HLLPF. It's a foreign primary stock. What I mean is, if you type in its ticker, I actually haven't done this in TrendSpider yet, but I usually use Bloomberg or I use Thinkorswim. I haven't talked about Bloomberg much, but where's June 24? Well, it's actually quoting it in TrendSpider, which is interesting, and it's intriguing to think about trying to buy it, but um, I don't think the volume's very much, and I just don't think you're going to be able to buy it. Well, it does have some volume. It has less than 200,000 shares traded, but it's a total penny stock, and I don't think you're going to find a broker. I think it's really important to look up these quotes in a broker. TrendSpider is not a broker. You want to look it up in a brokerage platform. I have one that I can pull up. It's Thinkorswim. It's the only brokerage platform I use besides Interactive Brokers. And I use Interactive Brokers for day trading. And I previously was using it for these portfolios and I stopped. And actually, I accidentally liquidated them while I was day trading. I put in a rule, and in the day trading course, when you get to advanced, I'm going to talk about hotkeys. And I put in a rule to auto sell anything that was down a certain amount, and it just cut a bunch of positions. So I said, I'm just going to sell them all. And I thought, the recession indicator is saying to be out. I'll just follow that. I kind of changed my rules a bit. I think I got back out of the market. Must have been like back here. So I actually held through all this, but I didn't catch this with it. So I'll talk about the recession indicator later. Right now, Thinkorswim's installing updates, but what happens is you look it up and it'll just quote you, some crazy price. So there's just no shares to fill. So what I did when I was making the paper was, if I got a rule like that, I wouldn't use it and I just move on to the next rule, because I kind of knew, like, deep down, like, it wasn't realistic. And I had actually published another paper showing a strategy like that, which I do track in real time and have been tracking, and was like geeked out when it finally in real time showed me a return like that. And I took it all the way down to, like, where is the stock that's doing that, and can I buy that stock? And I went, oh, these are really tough to buy. Maybe it is possible if you had the right broker and the right exchange and there was the right way to do it, but I haven't seen a way to do it. So what I've done is, like, I've stopped paying a lot of attention to those. I still track them, but I'm not paying a lot of attention to them. And when I see them in the screens, I just disregard them, because I'm thinking, you want to buy in a normal broker, Robinhood, Thinkorswim, etc. They're not in there. It's still installing updates, so I can't pull it up and show you. But when it's done, if I'm if it's done while I'm making the video, then I'll pull it up and show you. But let's keep factor modeling it, and then when we're done factor modeling it, I'll just briefly walk you through the stress test. So here it is again, same thing. I mean, yeah, I'd love to take this, but we can't take it. So let's go back and try again. As a fun caveat, the Sharpe ratio, which measures the risk adjusted returns, it measures the returns when the market's going up and the returns when the market's going down. You might only want to look at the returns when the market's going down. If you do that and you say, I don't care what the deviation is when the market's going up, I'm sorry, when the stock is returning positive returns, you don't care what the deviation is because you love a big deviation on the upside. It's the downside when the stock is selling off. That deviation is the deviation that you care most about. So the Sortino ratio measures only the downside deviation. All right, Sharpe ratio crawled back up to 0.85, and the standard deviation is dropping way down. So this still concerns me a bit, but I'm not going to worry about it, and I'll tell you why. And if now you're curious about it, we got rid of debt to equity of the stock in the most recent quarter being less than or equal to the debt to equity for the average stock in that industry. So when we get into like the Ludi recession indicator and then the advanced course, I'll talk about like how to look at stocks within different sectors. And in the advanced version of this course for the famous investors, I'll talk about how to rebuild these inside of Bloomberg. And then you'll learn more about how to compare a stock to the industry, which here you can learn about it through these rules, but until you really get your hands dirty and start to rebuild it, like in Bloomberg, then you really start to understand, like, here's my measure of debt to equity for my stock. Now, here's my measure of debt to equity for the industry. You have to rebuild all these little functions. Portfolio 123 is so nice because it does it for you. But if you want to take it a level further, doing it in a program like Bloomberg is going to give you more control over the data. And then eventually, I hope to, on top of that, start to do it in my own programming language like Mathematica with either my own data feed or with Bloomberg integrated data. So here, now the Sharpe ratio dropped down a little bit, but the returns jumped up a lot and the standard deviation jumped up a bit. So let's just keep it focused on the Sharpe ratio, and we're just doing a factor model, and it took us about a half hour. So I love to sit at the computer. Sometimes I talk with my advisor about like, you can just sit and work and like 6 hours go by and it felt like 30 minutes. And I love working like that. You just get into a flow, and like when it's just constantly on your mind, that's the time to do it. Otherwise, you just don't get it done. And honestly, like, I hate to take work home with me. I used to do all this from my apartment, and it just got so stuffy. I ended up moving all my stuff into an office at Lifetime Work, and it's worked wonders for me just to create that separation between work and home. And so when I go out of town, I'm looking to go to Miami this weekend. I'm not going to take any of it with me. I'm just going to leave it, and I'm going to go there, and I might bring my work laptop in case I need to like update the portfolios while I'm there, which I would like to streamline, by the way. I would like to get to where like they're updated on their own. And I think I have an idea how, but I'd like to create my own way how. or I'd like to get it to where you do them, and I just keep you updated on how to do it, and it'd take a little work, but then you can get them, in real time as you want to. But I understand the allure. Okay, now the Sharpe ratio is 0.86. We still have this huge update here, which I think if we go through all the returns, we can see up 23%. That's a lot. So what I learned as I continued to go through this was that you have to click here to view all the results. So just this 1 month is the only month that's a little high. And again, we're investing in 1,345 stocks. I don't want to buy 1,345 stocks, but going back to 2023 and walking forward to now, this is what I went through. It was like, how do I buy all these stocks? So 29,000%. Again, it started at zero, it went to 0.28. I don't want to leave the site and look at that stock, but it is interesting to look at those different charts. So here's where the issues are is like, okay, Thinkorswim's open. I'm just putting my security code in, and when that's done loading up, I'll try to pull a couple of these up. So FinDev Inc., TNSGF, they're loaded. You can't see them because I'm only showing the window. And got a really powerful Mac, actually. I bought a really nice desktop when I got a research budget at IU after grad school. And um, I've kind of always liked Macs. Most of the finance applications run on Windows, especially if you get into like the non-random chart patterns. They use a lot of functions from Windows, so um, you don't need the most powerful computer, but it helps to have a fast processor. But from what I learned, these new Mac processors, they do faster processes than the desktop does, and you can take it with you. But I try to just leave it at work, lifetime work. But I have my desktop here too, so um, I like it for most things. Um, but you want to get into those deep finance applications. Windows is kind of where it's at, but you can mostly do most everything on the Mac, other than a couple things. So let's not talk about that right now, but let's look at FinDev and HLLPF, right? I'm going to look them up first, and I'm seeing that um, well, it does look like it went up on. I need to have a little bit more than a year of daily data. I need like 2 years of daily data. So I'm introducing you to a lot of stuff, but I'll talk about technical analysis next time. And I did have a couple more things I wanted to do in portfolio 1, 2, 3. So let's leave this till the end. But I am seeing that in June of 24, it did go from 0.0004 up to 0.009. So it went up about zero point 0.6, but I'm not fully convinced you could buy it. Maybe you could. Actually, there may be some real opportunities here with the penny stocks, and I haven't even explored them yet. But for most everyday investors, let's just set them to the side for now, and that might be an opportunity worth coming back to. Um, So let me just share my screen on Thinkorswim. And now what you can see is that, if you're not a finance person, don't worry about it. I can turn all the indicators off and I can make it just take up one pane. So let's go back to June. Here's June. Where did it buy the stock? It bought it in June when it was basically zero. Okay, what's the volume? Looks like the volume is like there's only like 1,200 shares. So this would just be a real tough stock to buy. So you can understand why I turned them off. So it did do that. It did go from 0 to 0.01, which is what it said it did. But it's going to take some work to get that to where it can actually be usable, and it might have to be something that just comes at some point when it's just like all of a sudden, oh, it makes sense. You learn something from somebody somewhere and you remember back to it and you say, oh yeah, I remember when I was looking at that. So this one was December of 2022. So we need more data. So let's take 10 years of data, daily data. Actually, 2022 is only like 3 years of data, right? So let's go 5 years of data or 4 years of data. And then what you have to do is, so you can see right here, that's the date, 1/27/21. So 12 of 22. So yeah, I kind of bought down here and then it sold it up here. Actually, that really worked out. The volume was 8,000 shares. I don't think it's impossible to get these, but for streamlining it in a newsletter, it's not something that's very practical. So we'll come back to that if that's something you want. I'll keep working on it for you. My goal with this right now is to get it to where you understand it better, and then also like to get it to where you can use technical indicators from the day trading course to try to figure out like what stocks are going to pop. And so instead of investing in all the stocks, you're investing in like select stocks, because there's no way of knowing like which stock is going to pop. But if we could like narrow it down to try and figure it out, obviously we know they're the penny stocks, so we only want to buy the penny stocks. I think we could narrow it down. So let's run the back test now. Do we want to save it? I don't really want to save it. Let's just call it, Buffett dummy video. And we're calling it dummy because we were talking about dummy variables. So well, there's nothing there. So let's rerun it now. It's buying all the stocks. I don't need to save the log. It's rebalancing every 4 weeks. We have the factor model built. Now let's stress test it. So we're adding a layer on a layer. We have the screen, we have the factor model, which is optimizing the Sharpe ratio. Then we have the stress test, which is saying make sure that it holds up over overlapping subperiods and doesn't only work in that one big pretty little window. You want it to work over multiple windows so that no matter how you dice it up, you're going to get a good return. And then you want to keep evaluating it in real time so that you're confident that the returns will hold up. And that's why when you do that, you end up with returns in real time, like the ones that I showed you before. Like I started in July, I started tracking the stocks as they passed the screens, and I'd add them to a portfolio. And then I would see that the portfolio that I was adding them to was really close to the screen. So that's how I knew that it was good to send out as a newsletter. And then I started to invest real money, but it was really poor timing. in my investments class, I said the market's topping out. It's going to sell off to 560. It did. And then I looked at the prolonged yield curve inversion, which I had set aside 5 years ago, and said, oh, that's actually a recession indicator. Oh, we need to be out till October. And then I accidentally sold the positions after the market had regained most of what it sold off. And I said, I'm just going to stay out till October. And that's a good lead into the recession indicator. But also, I think that some of the technicals that I'll teach in the options and futures course that are linked to the day trading course, I'll go through the indicators in the day trading course because that's where I use them. But it'll overlap with options and futures, and it'll overlap here. So I hope that ties it all together. And then the dissertation non-random chart patterns will be usable here also as a separate piece, as well as day trading, as well as options and futures. So there's two different technical strategies. There's the automated chart patterns, which I haven't talked about, and then there's the technical indicators that I use. And among the technical indicators I use, they're applicable to day trading, to famous investors, to options and futures. So what's our issue? Our issue is we're still having some big returns. The returns are really nice. I mean, 3 year, 100. Who wouldn't want to invest in this? And honestly, like, it's still somewhat usable because even some of those tiny stocks, like, you can technically probably get them. But I think what I did to make it even more realistic. Well, the other issue that someone pointed out was like, well, for one, the number of stocks is insane. But for two, like the market cap, like some of the market cap, you're not a finance person. I know the video's getting really long. Um, it's just showing you how large the company is. So, like, some of these market caps, it's like 1.46 million, zero point zero 0.01 million. That's in like the ultra micro caps. So, what we want to do is we want to add a rule here. This is beyond the paper, price above $1. And let's see how that takes care of those penny stocks. It should take care of them. The other thing that I'll cover inside the course that I won't cover here is adding a volume price momentum indicator, which I gave a talk about recently. And actually, it adds about 300% return, total return, while reducing the risk. So it's worth adding on there. The Buffett model, the Graham model on all stocks, I don't think it adds to the return, so I took it off. But, this should definitely get you started. And it's free video, so I mean you can totally use it. But if you want to go through more about like um, staying up to date with how I currently track the portfolios and getting it as close to the portfolios that I send out in the newsletter, then you want to do that in the course. So now it's 1,700%. So that took a lot of the returns away. But now I know like I'm gonna get the best model, and for the most part, I'm winning. A couple times I'm not winning. And this is the Buffett model. So obviously, I go way farther than that in the newsletter. And this is almost a good stopping point, but I just want to introduce rankings. So you can take all the passing stocks, and instead of buying all of them, you can say, I want to rank by Buffett's criteria according to portfolio 123. And I only want to buy the top 15 stocks. So this is getting it like closer to where I'm at, but still, I haven't stress tested yet. So I'm going to wrap this up really quick. It's 44 minutes in. I'm going to take another 5-7 minutes total to wrap it up, and you'll understand what stress testing is, and we'll be done. And I probably won't post another video on this. I think this is for fund managers and more active traders and investment professionals and those who want to know as much as possible about the stocks that pass. And it's 147 one time. It'll walk you right through it, but you need to have a portfolio 123 subscription in there, I'll rebuild VPCI, I'll rebuild the famous investor portfolios from the paper, show you how to use a ranking system, how to create your own ranking system so you're not just using portfolio 1, 2, 3s, talk about the rebalance frequency, um, talk more about stress testing. So now we're well on our way. This is actually a pretty good model, but I don't think this is exactly the model that I used. But so far, I think it's good. And the market cap, there are some tiny market cap stocks. So the last piece I would do is I would say, you know, make sure the market cap is at least 150 million. And as far as like the actual Buffett model that I use, I don't think it's quite like this, but this is basically what I did to everyone. We're almost done. I'm bored. If I'm bored, you're bored. But this is like a typical class. So I'm going to post this video on YouTube, and then you'll be able to look forward to going through in more detail in the actual course. And right now, the course is on pre-sale, and you'll just have like a basic outline in there, but you'll get a very deep discount on it. And as I build out the information, then I'll increase the price. So this is your chance to get it very cheap. But now it's as realistic as possible. We don't have a market cap problem. We've got pretty good returns all the way through. So then I'm confident here I can go back and say, what are the last 5 years returns? This is what I did to every model is, I took the rules that I came up with. I made sure that the stocks were as realistic as possible, that you could actually buy in a realistic amount, and that, they beat the market over the long term, but also the short and intermediate term. So now, the 5 years, 3 years, 1 years, this is a good model. This is almost better than the model that I sent the newsletter on. I should probably change it. And I don't even have VPCI on there yet. The VPCI rule is like, I think I have it built out in here. It's like better than negative zero point 0.5 or better than negative zero point 0.4. I haven't talked about VPCI. VPCI is like a momentum, which is like you roll a ball down the hill, the faster it goes, the faster it goes. This is supposed to help you pick up momentum, but like I said, on the Buffett model, on all stocks, it doesn't do that. So I don't actually use it there, but it still does it. It just doesn't do better than without it. It doesn't need it. It's a different type of strategy. It helps with growth. It doesn't help with value. This is the value version of the portfolio. Um, but yeah, this is what I do to every single one. So what I'll do inside of the course is go through every single one and show you how I build them, how I stress test them. And the about feature is showing you the stress test. It's showing you if I go back 3 years and I run it, how does it do compared to the market? The other time frame that's very unique is 10 years, because that's like 2015. The market had been running up. It's very tough to beat the market over the last 10 years. And that was something I found out when I was going through these, was like, I could have it beat over all the time periods. I could have it beat over 5 years, over 3 years, over 1 year. I could have it eliminate stocks below $1, eliminate low market cap stocks, restrict the number of stocks. But getting it to beat over 10 years, it was tough. Um, but I incorporated the 10-year period into my stress test too. Buffett doesn't have a problem. But you're using their ranking system, which is basically just going through like our dummy portfolio is pretty good. So if you want to build these on your own and have free reign over them, then this is the way to do it. Then obviously you have it. You don't need the newsletter anymore. You can just pay the fee, learn how to do it, keep access to the course. Um, this is their ranking system. I didn't make this. Book value, valuation. You're not a finance person. Don't worry about it. I'm not going to get into complicated math, but there's ways to look at how a company is valued. If you were an investor and you wanted to buy the whole company, how would you value the company? And you could do a lot of complicated math. You don't have to. You could look at simple financial ratios or metrics. And in Buffett's book, he actually talks about using like a discounted cash flow valuation, which is just like how much cash does the company have. It's sort of like your textbook theoretical finance way to go. But there's not a way to do that in Portfolio 123. In Bloomberg, you can. So as you step it up to the advanced, then I think that's the way to measure it, is that way. There may be a way to do it in Portfolio 123, but anyway, stress test factor modeling these is another animal. And that's probably something to do inside of the course. If I do it all right here, you won't need me anymore. Where's our dummy model that we just made? So I actually rebuilt my own Buffett model after I went through and read the book again. I went through all the information again, and I tried to understand how he did things and like simplify it even more, and then build it out in a factor model. And it's not perfect, but I think it does pretty good. I wanted to make it my own, rather than send something out that was theirs, but theirs is very in depth. And I think taking it into Bloomberg, I talked about the advanced recession model and looking at, what sectors are doing well. Within that, I want to talk about what strategies per sector, and part of that is looking at discounted cash flow. So I think that's a piece I can just take out of there and put right in here. The other piece is looking at like CanSlim as a sector model. So that's what you get in the advanced recession indicator. And in the advanced famous, you learn how to rebuild these portfolios. So you can, start to put the two together for more like enterprise level solutions. So yeah, 1900%. Is that what we already had? I don't know. It might do slightly worse. It does do a little bit worse. I think their screen does better with the but I also have different rules in the one that I actually use, so maybe we could just go over to that. 10 years is the toughest test, so let's check out the 10 years. Then let's look at the one I actually use, and then let's wrap it up. 53 minutes is way too long, but hopefully this gives you real clear insight of what you get in the course. You get to learn how to rebuild them all on your own. Almost no difference on 10 years. Yeah, actually, it's about identical. Oh, because I'm using theirs. So this is the kind of stuff that I do when I'm just sitting around doing nothing. It's nerdy, but there's a carrot at the end of the stick. It's you want to find something that works that you can use, and ultimately you can help other people with. And I plan to start investing in these, and I plan to start figuring out what stocks you can buy. Yeah, so this, you got to use theirs with theirs, but that's what we built. But obviously, you could go in and you could start to peel back the layers more and start to change things and make it your own. So I might start to send this one out. This is a really good version of the Buffett model. And again, you get the newsletter. It shows you all the holdings. You just want to make your allocation match the holdings. Let me quickly take a look and see, because I recently went through all of these. So my Buffett model is different. I take out all the over-the-counter stocks and I look at price above $1, but I didn't remove all those earnings items. And then my ranking system is the one that I made, and I'm rebalancing every 4 weeks, but I'm only buying 10 stocks. I think this does better. So yeah, like you open Pandora's box, you start to you start to factor model the ranking system. Then you have to go back and factor model all the rules again. So isn't that fun? I mean, you change the ranking system up, you change, the central nervous system of it, and you got to go and rebuild the skeletal structure. So um, that, I totally factor modeled it, and then I went, I don't want to rely on their ranking system. I want to understand the ranking system better. So I think our version of it did 2,000%. Now it's doing 6,800% with the 0.79 sharp. So yeah, it's kind of wigging out a bit. I don't know why. I'm frozen. Um, but if you can still hear the audio, then I think we're good to go. Or maybe this is the time to stop. Or maybe this is my sign to not give up.